Good morning. This is Danny, Legislative and Communications Coordinator for CHNLA. Thank you for joining us today for our member webinar on Unlocking Better Hotel Financing, presented by Jennifer Davis, Senior Vice President, Business Development with TMC Financing. This webinar will be held up to about an hour long, and to respect everyone's time, we will accept as many questions as we can within the time frame. During the webinar, if you have any questions, please type them into the question box at any time, and we will try to answer your questions during a Q&A period at the end of the webinar. If there are any additional questions afterwards, Jennifer has provided her contact information on the last slide of today's webinar. We will also have a copy of the webinar in the Members Only section for you to review. Today's webinar will provide details on hotel financing loans, can be used for purchase, construction, renovations, and refinancing existing debt. Jennifer Davis has been in the financial services industry for more than 20 years. Jennifer is responsible for educating business owners, commercial mortgage lenders, and commercial real estate brokers about the SBA 504 program and other lending opportunities available through TMC. Now I'd like to introduce and hand over control to our presenter for today's webinar, Jennifer.
Thank you, Danny. I greatly appreciate it. And thank you to CHLA for hosting TMC Financing today. And thank you very much to those that have joined the call. Greatly appreciate your time. So I'm going to go ahead and dive right into this. Our very first slide, just Danny touched on it just a little bit, but it's about TMC Financing. So we are a certified development corporation here in Southern California. Northern California as well, and we also serve the state of Nevada. We've been in existence since 1981, and we provide long-term fixed-rate financing to business owners for purchase, renovation, construction of commercial real estate. We are the #1 hospitality lender in the United States. Very proud to say that, and we've put a tremendous amount of effort into understanding hospitality projects as well as the needs of owners. This first slide here just shows a couple of the brands, a few of the brands that we've worked with over the years. We have provided more than $9 billion to 5,000 business owners over the past 35 years. Specific to hotel financing, we can provide financing for existing hotel acquisitions, construction loans, so a vacant land purchase with the intent to develop, construct a hospitality project on that land, expansion costs, improvements and renovations, TIP requirements, FF&E, and then as of last year, we now have a refinance program, which I'll get into the details of that here in a few additional minutes. This first, kind of getting into some of the details around the 504 versus the 7A versus the conventional loan. This is a topic that comes up quite often, and I have the pleasure of speaking with a number of borrowers about the differences specifically between the 504 and the 7A loan. And what I'm going to do is this particular slide here kind of gives you some of the key points, but the next few slides get into some additional details. So I'm just going to skip over this for a moment, but this is a great reference point for you if you ever want to come back to just, again, some of the key differences and some key bullet points. This particular slide is specific to conventional bank loan financing for hotels. So similar to the 504 and the 7A loan, the proceeds can be used to purchase, improve, refinance a number of the items that I touched on earlier. TIP, FF&E, et cetera, are typically eligible for a conventional bank loan. Typical down payment requirement is anywhere from 30 to 35%. In some scenarios, I've even seen as much as a 40% down payment requirement. There is no limit to the number of projects or the number of loans, conventional loans, that an owner is able to obtain. And there is no maximum loan amount. So the loan, would be subject to whatever that particular financial institution's lending capacity is. The banks can finance either franchised or independent hotels. There's no kind of qualification. Now each lender may have their own preference, if you will, but there are lenders that do serve, franchise or independent hotels. And then the prepayment, the rate, the fees, all of that stuff is negotiated directly with the bank. And that certainly can vary by lender, specific to hospitality. So that's a quick overview on conventional financing available in the marketplace. And this next page here is just a sample loan scenario of what a conventional loan would look like. In this scenario, we've assumed a purchase price of about $6.5 million, a PIP cost of $1.5 million for a total project of $8 million. We've assumed an equity contribution of 30% down, so a $2.4 million equity contribution, about 1 point in bank fees, and then a typical appraisal and environmental of about $5,000. So your total cash out of pocket on a conventional loan scenario such as this is about $2.4 million. And then we've given some sample kind of pricing structure. The majority of these loans will be based on a 25-year amortization. And actually, in a number of cases, you may even come across a 20-year amortization. And then a 10-year term is fairly common with maybe a 5-year fixed rate and then a 5-year reset after that. Again, this is a sample conventional loan scenario. I'm going to move on to just SBA financing in general. There are two types of SBA loans. There is the SBA 7A and the SBA 504. Both of these loan programs are basically, designed to increase the owner's access to capital or preserve their capital. Those programs provide up to 80 to 85% loan to value when compared to, say, the 70 or 75% example I showed just a moment ago. Both of these loan programs, we can finance the real estate, the property improvement, etc. The goodwill and working capital is a little bit more specific to the 7A, but we'll certainly get into that in further detail here in just a moment. And then, as I mentioned earlier, the higher leverage allows the business owner to retain their cash on hand for business purposes, expansion, acquiring other hotels. So keeping that cash in the bank certainly gives that business owner, or in this case, a hotel owner, more options for future growth. So this next slide is specific to the 7A. The maximum loan amount with the 7A is $5 million. And typically, again, an 80 to 85% loan to value. One thing specific to the 7A I want to point out is that it is actually one loan. So the bank is actually making the loan, and then they in turn get a guarantee from the U.S. government. The interest rate is typically an adjustable rate. I've actually not seen a case where there's fixed rate financing available for a hospitality project utilizing the 7A loan. And then there is a maximum of prime plus 2.75. The 7A does have a shorter prepayment penalty. It's 3 years. It's a declining, prepayment. And then, as I mentioned, the loan proceeds are funded by the bank, and the SBA provides a guarantee. There is an SBA guarantee fee associated with the loan, and the percentage is based off of the amount that is guaranteed by the SBA and the amount that is financed. And I'm going to show you a sample scenario here in just a moment that'll kind of show you how that fee is calculated, or based on this scenario, what that fee amount is. The fee typically is north of 3%, typically anywhere, depending on the project size, can actually range from about 2 to 3.75%, and it's after $1 million, it starts to scale up. So a fairly safe assumption would be about a 3.5% guarantee fee based on 75% of the project amount. 7A loan proceeds can be used to finance the hotel, the business value, going concern, the working capital, the FF&E, all of the items that I've already mentioned, in addition to the PIP cost if required. And it says here at times, I'm going to say in most cases, additional collateral is required with the 7A loan. So here's a sample 7A loan scenario. In this scenario, because we have a maximum loan amount of $5 million, we put our project at that dollar amount. So we have a hotel purchase price of $4.5 million. We have a PIP of $500,000, and then we're assuming FF&E of about $500,000 for a total project of $5,500,000. In this scenario, we're assuming a 15% down requirement. So the equity injection would only in this case be $825,000, and the bank would finance $4,675,000. Typically, the SBA 7As for hospitality for real estate acquisition is going to be a 25-year term. We've assumed a rate of 5.5. Keep in mind this is an interest. This interest rate is tied to prime plus a spread and adjusts quarterly. So in this case, we assumed a rate of 5.5, a payment of $28,709. The fee in this scenario, based on this dollar amount, equates to 3.68% or $128,984. And then we have the cash injection of $825,000. The total out-of-pocket expenses in this scenario is approximately almost $954,000. Keep in mind, in most cases, the SBA fee is not financed, so owners will be required to come out of pocket for the 7A loan for that fee, in addition to their cash injection. So again, here's a sample scenario on the 7A, assuming a 15% down payment. Moving on to the 504, so one key difference between the 504 loan program and the SBA 7A loan program is that there is no maximum loan amount. We've had the opportunity to finance projects in excess of $25 million. And the way that we do that is we have a bank participant. So one of the key differences between the 7A and the 504 is that it's actually split into two loans. You have a traditional bank lender that will finance a portion of the project. The typical requirement is they have to finance at least 50% of the project, and I'll show you a sample here in just a moment. But on hospitality, they must finance 50% at least, and then we plug in for up to $5 million in the form of a second trust deed. And so the typical structure might be, bank at 50%, up to 35%, and then the client injects 15%. There is, and then in scenarios where we have a larger project, the bank can certainly increase their first trust deed from 50% of the total project to maybe 60%, 65%, whatever it is that they would feel comfortable with. And so that's how we're able to do some of these larger projects. There is no limit to the number of projects that a hotel owner can finance with the 504. There are some energy efficiency requirements, and I'll get into some specifics with regard to that here in just a moment. But you can utilize the 504 loan program for multiple projects. Unlike the 7A, once you've hit your $5 million maximum, you can no longer pursue 7A financing. You're capped at the $5 million. Again, loan to value anywhere from 80 to 85%. Funds can be used for the purchase, construction, expansion, renovation, equipment, etc. So lots of uses. However, we cannot include the working capital, franchise fees, or any business value. The SBA portion of the loan is a below market 20-year fixed rate loan, currently priced at 4.59, fully amortized over 20 years with no balloon payment. You compare that to the 7A where you're typically looking at a quarterly adjustable rate. And again, this is specific to the government portion of this loan. And then we can definitely finance, franchise, independent, multiple types of hotels qualify. So let me move on to an example. In this scenario, we have a hotel purchase price of $8 million. We have a PIP requirement of $1.5 million. and then we have FF&E of $500,000 that's being included in the purchase, giving us a total project amount of $10 million. You may recall I mentioned the bank must be at 50%. So in this scenario, we have the bank financing $5 million of the project. We have the SBA loan at 35% of the project, or $3,578,000, and then we have the buyer down payment requirement at $1,500,000 or 15%. Now the total project with fees is $78,000. The SBA fee is currently 2.15% of the government portion of the loan, so of the SBA second, and that fee is financed. The SBA actually requires us to do that. So just by comparison, so in this scenario, the fee amount is about $78,000 for a total project of $10 million. You may recall, excuse me, in the 7A scenario, we had a project amount of about $5.5 million, but a fee structure of close to $129,000 out of pocket. Down below, we've got an example where I have the bank first mortgage at $5 million. We assumed an interest rate of 5%. Again, the loans are typically financed over 25 or at the 25-year amortization. A 10-year term is required. Most often, it's a 5-year fixed rate with a 5-year reset, and similar to what I described on the conventional loan. And it is in this scenario, we have a monthly payment of approximately $29,230. And then we have the SBA second mortgage at the 3,578. So again, that fee is financed. That is a 20-year term with a 20-year amortization. So in this scenario, you're looking at a blended rate of 4.71. So this slide here talks about the unlimited SBA financing. Earlier I mentioned that you can have multiple projects with the 504 loan. And so if you're an owner that possibly financed your first hospitality project with a 7A loan and you'd like to grow your portfolio, acquire an additional property, this would certainly be one way for you to do it and not have to be concerned with regards to, exceeding your maximum. Essentially the way it works is we would look at what the energy consumption is for that particular project that you're acquiring, and then we would need to get a third-party energy report that would essentially determine for us what the 10% of the energy needs would be to be met by like a renewable source. Solar, wind, biofuel seems to be the most popular, with solar typically winning out. And we would then finance the solar panels to be put on the hospitality project. And that would essentially allow you to have up to $5.5 million of SBA dollars. And those SBA dollars stand on their own. So they stand independent of any other SBA debt that you may have. So again, it typically involves installing a renewable energy source, and that renewable energy source must generate 10% of the energy used for that project. So this is certainly one way where if you're at or near your SBA cap, that you could continue to grow your portfolio of hospitality projects and still finance them with a much lower equity injection requirement. So the next few slides are some examples of some projects that we've had the pleasure of closing. This is an independent boutique hotel in Ontario. And in this particular scenario, the borrower had actually not owned a hotel, had a tremendous amount of experience. And in this case, she actually had the assistance of some kind of silent partners that invested that helped the equity injection. So that's certainly a possibility for individuals. And this is, was a great project for us. We did require an additional 5% down because the SBA did determine this was a startup, given the lack of experience. The lack of prior ownership that our borrower had. But one example of a larger project at 20% down here in Ontario. This is an example. This next one here we recently closed. This is a property owner with a lot of experience and actually was relocating from Washington, had sold a property in Washington, and the family's coming down here to Southern California. You'll note the 15% injection. And again, we had historical financials from the seller, and we had an experienced buyer that demonstrated past ownership. So this is at a 15% down payment requirement, and this was just a straight purchase, including the building and the FF&E. This next example is a ground-up construction project here in Buena Park, and essentially this was, a 102 rooms, 65,000 square feet, Hampton Inn. Client had acquired the land. We helped finance the ground-up construction component and then work with them to convert the loan to some permanent financing. Hotel refinancing, so I mentioned this earlier. So the last three examples were specific to straight purchases. The other option, and we're seeing this become a lot more popular as CMBS loans are coming due. So basically a client has a couple options here. One nice thing about this loan program is clients can access equity trapped in their real estate holdings. They can, you can take cash out for qualified business expenses. So these would be basically up to 18 months of operating expenses. Operating expenses would include salaries, rent, utilities, inventory, etc. The maximum amount of cash out is 25% of the appraised value, not to exceed 85% loan to value. So there are some restrictions with regards to the amount of cash out that can be taken. We can consolidate multiple loans. Typically, these loans will have to have been in existence for the past 2 years. We'll need to make sure that they're paid in current for the last 12 months and that there was no ownership change within the last 2 years. So again, there are some items that we need to make sure we check the box before we go down the road on the refinance. But again, this is, and then you don't have to do cash out. So I've worked with a number of borrowers that are exploring refinancing into a 504. They may not have enough equity for a conventional refinance. So this is a great option for them, where essentially the bank would do 50% of the appraised value. We would do, up to 35%. Actually, in this case, we can do up to 40%, but in most cases, it's about up to 35%. And then the equity that's already in the building, that acts as your injection in that scenario. One other thing to consider on the hotel refinance is, again, well, let me back up. You get the long-term fixed rate financing on our second. It's a slightly higher fee structure. So the current interest rate is 4.7 compared to the 4.59 that I referenced earlier. But again, it is a 20-year fixed rate. We also offer a 10-year debenture on the refinance. And that is currently fixed at 4.54. So again, a great option for owners that might have a note coming due. Now again, this program, we are not able to finance existing SBA debt. So this would be a scenario where possibly there's a CMBS loan in place. We can finance seller financing. So if the property was acquired with private money, a seller carryback, that would be eligible, but we cannot use this program to finance SBA debt. And this next slide is an example of a refinance that we did in Reading. So this was a CMBS loan that had come due, and we essentially refinanced about $6.7 million in debt. The bank took on 50% of that. We filled in the difference, and there was enough equity in this scenario where the client didn't have to come in with additional cash. In situations where there's not enough equity for us to meet that minimum 15% requirement on the refinance, then the client can certainly bring in additional cash to close the refinance. But what's nice is if we utilize the 504, that equity injection requirement would definitely be a lot less than a traditional conventional refinance. So I mentioned this earlier in the slide. We're actually coming to the end here. We serve the state of California and the state of Nevada. We have a number of business development officers, such as myself, in the state. We have, again, over 35 years experience with one of the largest and most diverse portfolios in the industry. It's really our role to act as your advocate and your advisor. We package the loan for the SBA. So we're really here to educate you, answer any questions, prepare different scenarios, help guide you in terms of lenders that are in the marketplace, that are active in hospitality. We are here to help you, act as your advocate, and again, act as your advisor. And there's my picture, phone number, and contact information.
Thanks so much, Jennifer.
Absolutely.
And I see we do have a couple questions here, so let me go ahead and ask you them. Are there any disadvantages to doing a 504 loan compared to a conventional?
Well, the typical, I guess if that answer depends on the client's specific needs and kind of where they're at from a liquidity perspective. The 504 loan or 7A is going to be a more expensive option. You have an SBA guarantee fee that you need to take into consideration, as well as possibly a longer prepayment penalty. My apologies, I did not mention that the 504 has a 10-year declining prepay. That equates to about 3% year one, 2.9% year two, and declines from there. Depending on how the conventional loan is structured with the lender, again, you're typically not going to have the SBA guarantee fee associated with it, so it's a less expensive option from a cost perspective. And depending on the type of terms you can negotiate with the bank, it could be a little bit more favorable from a prepay or a rate perspective. But again, the significant disadvantage, in my opinion, on a conventional loan is the amount of equity injection that you're required to make. And having been a lender for a number of years, once that equity has gone into that project, whether it be a hospitality project or just a straight purchase of an industrial building, it's very difficult to get that equity back out. So although we do have a refinance program, again, there's not many programs in the market that will allow you to tap that equity. So I'm a huge fan of keep your cash and position yourself and your business, for future growth.
Great. Another question, what is the maximum loan you can do with a 504, and how long does it take on average to get?
So there is no maximum loan amount, or I shouldn't say, sorry, there's no maximum project amount. Again, once you start getting above about 30 million, there's fewer lenders that are willing to do the advance rate that would be required, or we might have to request, an additional equity injection from the borrower so that we can kind of bring the total project together. But there is no project maximum. Our loan, the SBA loan, we cap out at $5 million or $5.5 million if we go green on the project. And then typical time, I have closed a hospitality project from kind of the day we opened escrow to the day we funded the loan in 25 calendar days. Candidly, that's fast, and every individual brought their A game. In most cases, 60 to 90 days. For hospitality, I'd say 90 days is appropriate. And again, a lot of our ability to close these projects quickly has to do with, client engagement and how quickly they're able to, get to us the items that we need to submit the loan to the SBA.
Great. I see one more question here. What are the prepayment penalties for the SBA loan?
So the 7A loan is a 3-year prepayment penalty, 5%, 3%, 1%, and then no prepay after that. The 504 loan is a 10-year declining prepay. It equates to, it's a calculation based off the loan amount times the interest amount that would have been earned that year, and then there's a premium, so 1% year one, and it declines from there. So it equates to about 3% year one, about 2.9% year two, 2.8% year three, and declines from there. So again, a 10-year declining prepay. Often people think that it's a 10% year one, 9% year two, 8% year three. That is not true. Again, 3%, 2.9%, and declines from there. And one thing that we do at TMC is every borrower that we interact with that's, comparing the two loans, we will sit down with you. We will prepare a sample prepayment schedule for you specific to your loan amount, and we will absolutely make sure that that's, clearly communicated with you, and that we show you exactly what that might look like.
Great. Well, I don't see any more questions, so I'd like to thank you again, Jennifer and TMC Financing, for presenting today's webinar and helping our members learn more about hotel financing. And thank you to everyone joining CHNLA for today's webinar. Please continue to check our website for a copy of this webinar in our Members Only section, as well as checking for upcoming webinars. You can find this webinar and future events at calodging.com. This concludes today's webinar. Thank you all for listening.